So in addition to investing in traditional real estate through cash or taking out a mortgage, you should definitely be looking into synthetic real estate investments at this time, given the current overpriced situation in the market where many homes have doubled in price in the last year, whether that be due to inflation or migration from cities to country, or from California and New York to places like Florida and Texas, because people are sick of and in the cities that they have lived in. So investing in a synthetic portfolio right now might be actually the best approach to real estate when there could be a market crash coming and lower the price to entry, because like any asset, you don't want to buy at the peak. Right now this is a seller's market, so people who are selling are profiting nicely. However, the people who are buying stand to have a huge risk for when the market dips, that now they are paying more on their house and owe more on their mortgage than what the property is actually worth, which is why I highly recommend investing in synthetic real estate portfolios, either through real estate investment trusts or through actually tokenized assets. And for people who are even on 2 incomes and definitely 1 income, it might be a bit too expensive to buy a house right now in many places in the USA. I'm not sure about the rest of the world, but I do know that here in Israel, Tel Aviv was recently ranked among the highest and most expensive cities in the world in terms of cost of living. So with that said, I'm looking at the website for a crowd investing platform called CrowdStreet, hence the name, and you can look at the different types of investments based on how much you have to invest, and sometimes the barrier to entry is still quite high and you have to be an accredited investor. So I was looking around on their website, and if I'm a non-accredited investor, it seems that they don't have any projects available. However, they did in the past, such as this Medalist Diversified Real Estate Investment Trust, which was $5,000 minimum investment. If you're somebody who maybe had $5,000 that you thought you could put towards a down payment, instead you could put it towards a project like this, where you're working with a group of other much larger investors who can help you get started and make some returns on your real estate investment without necessarily having to take all of the risk of a mortgage or managing a property by yourself. And what do I mean by taking on the risk? Because some people, you want to own that property. You want to know that you have somewhere to live that's not just renting somewhere that you own. But the thing is, and we saw this in 2008, is that when you're buying a house at a market peak, just like any other asset, the market can certainly crash. And what happens when the market crashes? You're underwater in your home, because now you owe more on your mortgage than the house is actually worth. And this is a situation that myself and probably many other people are thinking about right now, where possibly it's not so hot to enter the market and people are paying way more than they need to buy a house in this time. It's great for sellers. If you are selling a house now and you more than doubled your money or more than tripled what you paid for your house, more power to you. However, I do not want to be the buyer of your house who's getting suckered into paying more than what it's worth. So with that said, we can also look at other crowd investment platforms for real estate, such as Fundrise, which tend to have a much lower barrier to entry and have been talked about by many prominent media outlets such as Wall Street Journal, Fast Company, Forbes, New York Times, and Bloomberg, right? So you can manage all of your investments from this app, and these tend to be long-term as well. So when you put your money in here, think of this as actually what you would have with a real estate asset. You buy and you hold long-term, and that's how you get your returns on your investment. This isn't a quick flip. This isn't some kind of rare gem where you're expecting 10x. It's a steady, solid investment to help build your portfolio over time. And that's why people like real estate, is because it's solid. And we'll get to how real estate is becoming a liquid asset in a minute when we talk about real estate and blockchain and how you can tokenize real estate assets to make them liquid. When it comes to what I hold in my stock portfolio, it's going to be dividend ETF funds as well as REITs. And what is a REIT? It's a real estate investment trust. And this is basically a collective group of owners can own real estate as a collective. So this NerdWallet article is really interesting about REITs, how they work, and some examples that we also mentioned of how you can get into crowd investing in real estate. There are different types of REITs, such as hybrid REITs, mortgage REITs, equity REITs, and publicly traded as well as non-publicly traded REITs. So the next thing I wanted to look at are the top 25 REITs with rising monthly dividends. Forbes wrote an article about this earlier this year in October, and I thought it was really interesting to see these different REITs and their performance over the last few years. I am thinking about investing in a few of these myself, but full disclosure, I haven't made any decisions on which of these I intend to purchase. In fact, right now I am making this video in a sense as a form of research, because I too am looking to invest in real estate outside of the current market structure. And what is a tokenized real estate asset? It means that you can use an ER 1400 governance token, which is built on the Ethereum blockchain, and that token is actually registered to a licensed security that is regulated by an SEC approved authority, and thus the asset can legally be tokenized as a security under current regulation. You know, it's on the cutting edge of development, and it's the way that real estate is becoming a liquid asset. All of the articles I'm talking about are going to be linked below. So let's start from the top at REITs. So number 1 is Four Corners. It is a 5th top ranked REIT and was formed after a spinoff from Darden Restaurants in November 2015. It is a real estate investment trust which primarily acquires and leases restaurant properties. The next one is CTRE, which acquires, develops, and leases skilled nursing, senior housing, and other healthcare properties. This one, given the current situation, might actually be more valuable because healthcare is becoming more and more of a focus, especially as we have an aging boomer population. And number 3, the Alpine Income Property Trust, 71 net leased retail and office properties. Okay, this is interesting. So I probably wouldn't invest in this REIT because office properties are probably going to go down in value over the next several years as people demand to work more and more from home, and that they enjoy a flexible schedule, that companies won't be spending as much on their office properties. Just keep that in mind when you're looking at different real estate investment trusts, which kind of property that they're mainly investing in, and that way it can help guide your choices based on current market trends, right? So let's just keep current events in mind as we plan our investments and how those current events could affect the market, because it is very real, and if you have a keen eye for new trends, you will be able to beat the markets and make lots and lots of money when you are able to spot the trends well in advance or stay with the current times. Well, let's see, Omega Healthcare Investors, number 4, OHI. It is focused on skilled nursing and assisted living facilities. So this is again similar to one of the last ones that we talked about. And the next article I want to look at is really interesting. It's a detailed article about building a synthetic real estate portfolio as written by a highly experienced real estate lawyer. And I have linked this article in the description below, so you can go check it out yourself. I think that being empowered to do your own research is extremely important, which is why these videos are educational and entertainment tools meant to help and inspire you on your financial freedom journey. So I really thought this guy had a lot of interesting stuff to say. He's a 73-year-old lawyer from Manhattan, and he talks about certain funds he would invest in, and then why he would invest in them, and then which properties and REITs he would totally avoid. And I like his breakdown of everything and his reasoning, and I highly recommend you go and read this article. He talks about ALX Properties, which owns a block in Manhattan located between 58th and 59th Streets, bounded by Lexington and 3rd Avenues. And if you are not familiar with New York, this is an extremely valuable area of Manhattan where wealthy assets are concentrated. There's a lot of money in this part of Manhattan, and as is true for Manhattan in general. So I am definitely going to look into investing in this property. I might do another video to update you guys on what I decide to buy and how much and how the investments performed. I think it's important to be transparent. So at the time of making this video, I haven't bought any of the assets I'm going to mention here, and I might create a follow-up video to go over what I did choose to buy. However, I want you to make your own decisions on what you think works for you, because I am not a licensed financial advisor yet, and it's up to you to determine what's going to work. I prefer to own exchange traded funds or index funds because they tend to have a lower degree of risk, and I'm not really in the stock market to expose myself to risk, but more to hedge against inflation and maintain like a sort of long-term growth and stability for my cash instead of just leaving it in my bank account. So he writes about a couple things. The first one, ALX, is one of my favorite. Robert Lewis has a lot to say about all of the different properties and options out there for you, and I am not going to sit here and read this whole article because I hope that you can read. If you can't, let me know, and maybe I'll make a video of reading the article just for you, because I really do care about my audience. However, let's see, what is, wow, Maserich? What is that? Makerich? Anyways, sorry. How do you say this? The Makrike. Anyways, okay, so this MAC, according to its latest annual report, MAC owns 47 regional shopping centers in densely populated markets throughout the United States. So here's why I wouldn't want to invest in this one. And even though he is a very experienced individual in this field, I don't think that shopping centers are going to be as big in the future. People are not looking necessarily anymore to go out to go shopping. People are going online, going on Amazon, and the pandemic has drastically changed the way that people operate on their day-to-day shopping needs. So maybe this would not be even on my top picks list. However, please let me know your thoughts in the comments. I do look forward to reading what you have to say. Cedar Realty Investors, CDR, owns grocery store anchored strip shopping centers in smaller communities. Their business model is referred to as necessary retail. So this is something that could definitely work, especially when we talk about the prices of real estate going up for buying property in many cities around the world. There might be people going towards more smaller places in order to have access to larger yards or more space to relax and enjoy themselves without too much government oversight or pressure from their neighbors to social distance, and that living in a smaller place might give people more room to relax and enjoy their life. Additionally, necessary businesses is something that's always going to be around. People will need to go to the grocery store, people need to go to the pharmacy, so investing in real estate that is necessary is always a good idea, because people will always need some things no matter what, like farmland, water, food, shelter, all of that stuff. So I've already talked to you about real estate investment trusts, and if you want to get involved in tokenizing your real estate assets, I think you should check out this company, Solid Block. The barrier to entry is quite high. You must earn more than $200,000 a year or have a net worth of over $1 million. If you're a couple, you need to have a joint income of over $300,000 a year in order to be considered qualified to invest in the real estate assets that Solid Block is offering. So if you want to take a look at the marketplace here, we can see they've had some funded projects already, and in fact, the St. Regis Aspen Resort is one of the first projects in history as a real estate project that has been tokenized into a blockchain asset. And this is really cutting edge. This is creating history. This is breaking news, and I'm surprised that I hadn't heard about this company sooner. Let's check out the asset. There's documentation that we actually can't currently read about because we are not logged in as an accredited investor, but I just want to show you kind of a general overview of what the project looks like. So, tokenizing real estate assets is a way to secure your place when your investment. For example, someone can't go back in and alter the ledger or take more than their fair share of the dividends on a project. The blockchain ensures that all investors will always be fairly distributed to, and that all the allocation of the tokens can be seen publicly on the blockchain, and it helps keep things transparent for all investors, and it helps keep things more easy to manage for the people in control of distributing those dividends. $18 million for this project from May 2018 through December 2018, and created 18 million tokens with a 7% target internal rate of return, which is pretty good. If you don't know what internal rate of return is, it's a financial indicator that the internal rate of return is what the investors will receive based on the money that they put in. Okay, and when you want to start in a project like this, you must have, like I stated, a certain level of income, a certain net worth, as well as a minimum of $5,000 to invest. However, these are going to be highly cutting edge projects that getting into now can be something that will last you for the long term, and it will be a safe return on your investment. And tokenizing real estate is something that is incredible, and you will probably start to see it more and more over the years. And Solid Block might become a name that you start hearing on the news, and you'll remember this video and when we talked about it here together. So this is a presentation for a London digital bonds that I was curious about in London, where they are going to flip certain residential properties in the heart of London, and you can download this from their website. I also will put the link in the description to solidblock.co. If you are interested, you should definitely go check them out. I'm not being paid by any of the companies mentioned in this video, and I receive no commissions if you decide or not decide to purchase any of these assets. I just want to share with you some alternatives for getting into real estate that don't necessarily involve the traditional methods that you are aware of. So with that said, let me know if you decided to invest in a REIT. If so, which one? Have you ever heard of tokenized real estate? Are you considering purchasing any synthetic real estate assets? Have you bought a house this year? I'm super curious to find out. Let me know in the comments below. All of that said, thank you so much for staying till the end today, and I hope you have a great weekend. Shabbat Shalom. Bye. Thank goodness for editing, right?